is talking about some tactics on how to deal with pricing within inflation. Very practical tactics. I'll just, before I jump in, I won't work our way through this, but just to give you a little bit of background on Revenue Management Labs and who we are. Basically, we work both in B2B, B2C, but the key thing I'd like you to take away is we've been on both sides of the table. We've been on the consulting side and also in industry, like yourself. So what we're going through today, we've designed it so that it's very practical in nature. And our hope is that after coming out of this, you can go directly into your organizations and start to try some of these things. So I'm sure you've seen the headlines like everyone else. Labor is going up, shipping is going up, freight's going up, commodities are going up. And what are companies' natural reaction to what's happening out there? And I'm sure you guys have heard these screams as well, but price. Let's price our way out of these headwinds that we're seeing from a cost perspective. Now, the thing is when we're getting that push, the first way that we naturally react is we result to where we've been to in the past or what's easiest. And the easiest thing is cost-based pricing. When we look at cost-based pricing, it's great because it's quick to calculate if we've got a handle on our costs. It's we know that we're covering our costs, not a lot of resources. If we have a ton of SKUs or a ton of services, it's very, very fast. And it's easy to communicate to customers. We can just say, look, our costs went up by this amount. We're totally justified. This is how we're moving forward. But there's a lot of problems to cost-based pricing, and I'm sure that this group is familiar with it as well. Whenever we drop in terms of we realize efficiencies or we get cost savings, we pass that back to customer. Our gross margin target on what we're baking on top of our costs, it has nothing to do with how a customer actually sees our offering or what value we're driving. Also, this pricing is based on input costs. And those input costs are always moving around. If we're looking at, well, what shipping rate's going to be or what's the price of copper, we're always behind. So our pricing is always constantly trying to catch up. And really the big thing is that we're not focused on the customer, so we're always under or overpriced. We're never properly priced if we're using cost-based pricing. So we need to do something better than that. But let's kind of pull it back a little bit. And basically we have a portfolio here. We have product A, B, C, D, E. This is what it represents in terms of our sales in the portfolio. So product A represents 40% of our sales. And here's what our cost increase are that we're going to get on each of these items. And basically, if we go ahead and we take that cost increase, we're going to see a $3.6 million margin impact to us, negative. Now, the first thing we can do is we say, okay, overall, this blends to 5%. We put 5% across everything. We lose some volume on some of the products, and we end up with a $3.2 million negative margin impact. It's better than where it was, but we kind of peanut butter blended it. It didn't make customers react in a certain way. Next thing we can do is we can take the actual commodity impact that we are seeing on each of the products or services, and we plow that in. Once we plow that in, we see a different volume impact on each of these items, because now as opposed to product B going up 5%, it's going up 3%. And we see that the total margin impact, now we're only experiencing a hit of $1.5 million. Or we can go to understanding what our elasticity is around these products, taking differential price increases, and the volumes look much different. And it's actually resulting in not only covering our commodities, but giving us an incremental margin. So at the end of all of this, kind of the takeaway is cost-based, it's not the optimal solution. We've got to figure out a way to get to this value-based equation and understand customers. So how do we do that? What's overall? We talked about cost. When we're building up a price, a lot of companies say, let's start with our costs, really understand them, bake a profit margin on top, and how much am I going to discount it? Bake that on top too if we're doing a good job. And there's our price. The problem is that your value is somewhere above this. Hopefully it's somewhere above this. If it's below this, we're out of business. But your value is hopefully somewhere above this. And there's a lot of things that go into that value. And I won't go through all these, but what we're thinking about when we think about those value drivers, we're thinking about, for example, how am I helping my customer reduce costs? How am I helping them grow their business faster? How do I help them improve their quality or improve their scalability of their business? So there's all these intangible factors that we need to make very tangible and we need to quantify so we can figure out where is this value line sitting. Now, I'm going to take you back to a little bit of economics 101. What's kind of critical is that with those value factors that I was just talking about and that value line is with all this inflation coming into the market and we've got this pandemic happening, customers have really shifted in terms of their needs, in terms of their price sensitivity, in terms of how they're seeing the market. And I'm going to take you back to economics 101. We've got a quantity along the vertical axis, and we've got price along the horizontal axis. Now, this is just our demand curve. And if we have one price in the market, really, and let's say that price is right here, the revenue that we get is this blue box. Now, all that revenue management is what are we missing? How do I go and get more dollars? And when I look at this, where the more dollars are, it's all this white space that's under this curve. So how do we go after that white space? We want to create multiple offers because you can see all this white space that we were missing up. If I had some higher priced offers, I could go ahead and capture that volume. Or if I had some lower price offers, I could capture that volume. Want to capture as much of this white space under the curve. But how do we do that? And this inherently comes back to value as well. The first thing I want you to think about is that these are segmented offers. And when we're thinking offers, each of these segments relate to customer. So we really need to start with the customer. So let's step into the customer. And the previous presentation I saw had this, the right customer, the right offer at the right price. So how do we do that? Well, we need to start dividing our customers. And typically how people divide customers is they look at what industry they're from, what size of customer they are, or where geographically they're from. But what we really need to do is focus on what are their behavioral attributes. Because if we know their behavioral attributes, we can start to get to their needs. So you're thinking about things on how widely does the customer buy with me? How do they react to price changes? How much do they lean on my customer service? How much of the how transactional is their purchases with us? Once we get that understanding, we create segments. And this is just an example here. We have 5 segments, A to E, and each of these segments are the same size. Obviously, they're not going to be in your business. And what we want to do is drill down on what's important to them. Now, this is just for purely illustration purposes, but we've got three attributes here. One is price, and price is always going to be an important attribute. Number 2 is the content that we're providing to them and the quality. So segment A here, they have very low price sensitivity, but they have very high needs around content and quality. So knowing segment A, we develop offer 1 for them. And what we've developed here is a very premium offer. It's priced high. We're not going to sell a huge amount of it, but that's specifically designed for segment A. Now, what's critical is that your business already probably has these segmented offers in place. With what's going on with the inflation in the market, understanding how this has shifted over time in terms of these segment sizes, what's important to them, how the price sensitivity has changed, that will change what offers we're putting out into the market. So that's the first thing we need to do when we're reacting to inflation is fundamentally rethink our value, what we're providing to consumers, what has shifted in the market, and do we need to adjust our offers to compensate rather than just going ahead and the price of copper went up by 5%. Here's a 5% increase. Do the offers need to shift, and how will that result in incremental benefit to us? The second area is thinking about how do we protect our price integrity. So we're going to get a lot of customer asks now. I want delayed or flexible pricing options. I want you to give me a price concession. I want discounts. Your prices are much cheaper. If I go online, I can get much cheaper pricing. Competitors are much cheaper. Now, our knee-jerk reaction is, we want 63% of our salespeople, they're uncomfortable with having discussions with price, because salespeople are trained to get to the yes. They want to find common ground. They want to get to the yes. They want to grow with the customers. So whenever customers' price discussions come up, they want to quickly accommodate and they want to avoid the conversations. The problem is that if we give those concessions or we're not ahead of this, there's a lot of drawbacks that we come into. One, the customer gets an expectation that every time they come to us, they're going to get relief. We're training them for them. When we take down our price, taking down your price is much easier than taking up your price. There's a lot more work to do there. When we've taken down our price, we're inherently saying to the market that the value of our offer has actually deteriorated. When we adjust one customer, it can affect all the customers depending on what kind of visibility is out there in the market. And the other thing is that at the end of the day, we're deteriorating in terms of the dollars that we're pulling in. So we know these concessions are expensive to us if we don't have our hands around it. So what do we need to think of? And playing back a little bit more of a give and take. So the customer comes to us and says, your prices went up by 10%. Can we get a discount for being a loyal customer? We respond, of course, but only if you extend your contract by 4 years. The customer comes back, okay, but I'm going to need some free add-ons if we're extending the term. That's fine. We'll give you free add-ons. In exchange, I'm going to have to cut your 3% payment term. We're going to take that down to 1%. Now, what's happening here is as the customers are asking for concessions, we're going ahead and we're able to look at how to hook them in for the long term and have go ahead and ask for counterpoints or a real negotiation. So as we think about ways to extend the relationship and upsell, you're going to need to look at your business, but you want to think about how do we extend the terms in our contracts? How do we expand the scope, expand the number of licenses? If we've been looking for data visibility from that customer, how do we work this in now? How can we look at exclusivity terms? All of those elements. But soon as the customer opens the door, this does not need to be a one-way discussion. It can be very much a two-way discussion because they are having an ask. It's you want to make sure that you're already locked and loaded for what we want our sales teams to go back and respond with, and that we've ran the business cases and we know where we're sitting. The next element is price leakages. So we've talked about the first thing with inflation as opposed to just going cost-based. Rethink about our value. And do we have the right value on the table? Next thing is, as we know customers are coming to us, think about if the customers have asked for us, what asks would we have for them? Now we're going to take it down on one level more. And what we're really focusing on here is, I'm sure some of you have seen this, but if not, it's what we call the price waterfall. And just to walk you through that, you start with your list price, and we're starting at $100 here. And we walk through all the investments we make into the customer. So we actually provide a SKU discount of $12 for this. Since they're doing central invoicing with us, they get another $8. They get a scale discount to their size of $6. They've got this $5 discount in there as well. They do electronic processing with us, which gives them $4. And then they've got, we have enhanced payment terms with them, which gives them another $2. So this is $100. It goes down to $63. Now, we don't necessarily need to stop here. We can think about how many people we have on the account, all the advertising we put into this account. So it's as granular as we want to make it. But we get our $100 to our $63. this is kind of our pocket price at the end of the day that we can go out and we can show the customer, hey, yep, you're seeing $100, but here's $63. And then we have cost of goods sold at around $25, so our net profit's $38. Now, with inflation coming and just saying, okay, I've got 5% inflation, let me go ahead and take my list price up 5%, we're missing out on rethinking what are all the other drivers within our business. Now, the critical thing is as we take the time and we go and get this picture, what we want to look at is, well, what of these elements are investments? And when I say investments would be things that where I put money into it, I can run a business case and I can show you that that builds our top line and it builds our bottom line. Or a leakage. And a leakage is just exactly what it sounds like. You're putting money into it, but you can't justify that it builds your volume or your profit whatsoever. So what we want to really think about is, given that we have this opportunity to really rethink our costs and how we're investing, well, what are the high leverage items that are driving returns for our business and what are? So how do we do that? How do we step that to the next step and think about that? Well, there's a couple questions to ask yourself. One, you're going to need to run some math, and you're going to look at areas where you've actually increased the level of spend. What did those customers grow or not? And if you have a multitude of spends or a multitude of programs and a wide enough data set, you're going to be able to see, okay, here's kind of my top performers, here's my middle, and I'm not necessarily sure, and here are the terrible ones. We should get rid of these. Working with the team as well, looking at which ones are your most visible discounts or your most visible programs, and thinking about some of those long tail investments. How do we get that out of there? Looking at where the financial impact is, where you have some of the most leverage. As you're thinking about this as well, you can also think about looking at where that list price is and where that net price is. Am I selling the customers the optimal product or service? Do I have a vested interest to push them into, or push or motivate them into different areas of the portfolio? And how can I think about moving some of the investment in certain areas into other areas? Hey, I can put you into this product and here's what that can look like. So it's really going through at more of a detailed level, getting this visibility, getting the picture clear in your head, and thinking about what levers we want to pull. I think what the key thing is that, if we just pass a 2% price increase, it's 2% on the top line. If you're taking 2% out from all these other costs, or we're putting 1% more in and we're seeing that growth associated, we're going to get to the same place. But it's much more granular, much more targeted work to be done. So then the last element is your sales team and thinking about how you really help your sales team. So you go ahead and raise prices. Customers are hitting them from all perspectives. Why you're raising prices when competitors are not? Are there any rebates you can give us to offset this increase? Can we get any free add-ons if we buy from you? If you do this, we're going to walk away from you. Now, we already said salespeople, they don't want to deal with these type of discussions. They're often negative. They don't want to talk about price. So we really need to enable our sales team and help them. And how do we enable our sales team? We need to help them get over these customer objections in a structured manner. And we almost need to, if you were answering the question, how would you answer it? So as we think about what we've talked about today, you really want to put together a playbook and helping your team navigate all these cost concessions or discount asks or decreases. And your playbook's going to have really three elements. And it's the three elements that we covered. The first one is, since you've done another deep dive on your company's value and your value relative to competition, you're going to help them communicate. What is the value of that offering? What are the differential attributes on that value? And here is why certain offers fit certain customers. And here are the trade-offs that that customer can make. So if you'll remember, I kind of had that curve and all those different offers. We're helping salespeople put options in front of customers. Hey, you can go down to this lower option, but here's the trade-offs you need to make. And here's what you need to think about on how that'll affect your business. So really having them locked and loaded to have that give and take discussion versus I need a cost concession. I need 5% of your sales person saying, well, let me see what I can do. The second element is the give and take of the managing trade-offs. So when a customer comes in with an ask, we have already ran all the business cases and we know, okay, when you get an ask, this is the first thing I want you to ask for. And you can offer the customer. This is the second thing you can offer the customer. This is the third thing you can offer the customer. And here's where we draw the line. None of these things will actually be contemplated. But if they do this, we're willing to do this. If they do this, we're willing to do this. So we're giving the salesperson options again that they can have a very proactive discussion. They're not getting it. They're bringing it back to you in firefighting, or they're getting it and they're making a decision on the snap, and then you're locked with the decision. And then the last element is with the cost to serve or that waterfall that we showed you. If you're thinking about what are the areas that you really want to push cost out of, and what are the areas that you might want to reinvest, having a real structured message to your sales team to help them understand where those ROIs are, why we're doing these things with the program changes, and what that means to different levels of customers and what it's avoiding. I'm not necessarily, hey, I'm not just going out with this 5% inflation right across the top, because this makes much more sense to us and drives our business. Now, what's critical about this is once we've created this playbook, however it's going to look, is making sure we have the right infrastructure in place to have the reporting on it, the systems to pull the data, that we have a review process in place with the team on everyone who's a stakeholder and the right approval, all the infrastructure to make sure that it lives and comes alive within your organization. Because if you're just putting it out there and you're not tracking it or the adherence to it, you're obviously not going to be successful in getting that out to the market. So I know that was a lot of information relatively quickly, but just to sum it up, there's 4 steps to price effectively within this inflationary environment. 1, review your value quantification versus the market. Do we have the right offers? Are we positioned in the right place? Where do our prices make sense? Secondly, you want to protect your price integrity. So you're going to look at, we know customers are going to have asks. What are we willing to negotiate on? And what do we want to go ahead and ask the customer to trade off for price concessions? Number 3, how do we think about leakages? And where we're making investments, what are the ROI that we're getting for those investments? And how do we think about optimizing those investments? And the last element is, once we've got that in place, packaging it to enable our frontline sales team that they're locked and loaded to understand what they need to be doing and the playbook that they need to affect. So those are the real key elements I really wanted to share with you today. And again, I think this is a lot, but starting with one element, trying it within your company, just from a practical perspective, and making some gains there. Thank you.